In this module, we shall learn about business fixed investment, residential and inventory investment. For a layman, investment refers to buying existing physical assets such as a residential property or office building, etc. But in macroeconomics, the word investment has a specific meaning. Investment is the flow of spending that adds to the physical stock of capital. This definition is sourced from Dornbusch and Fisher and Stats. Some features of investments are: investment involves the sacrifice of present consumption and the production of investment goods. Next, it is a flow concept. Next, it is the most volatile component of aggregate demand. Next, it is one of the determinants of long-run productive capacity of the economy. Next, investment affects both the aggregate demand and aggregate supply, as an increase in investment expenditure increases aggregate demand, and by adding to the productive capacity, it increases aggregate supply. Next, investments are generally self-financing. This is so because when investments are well planned, then future returns from the creation of new assets shall pay for its cost and even provide some profit. Next, investments are self-terminating because when the creation of asset is complete, the investment stops. Investments can be divided into three subsectors: business fixed investment, residential investment, and inventory investment. All these three subsectors are subject to fluctuation. After studying this module, you shall be able to understand what is meant by business fixed investment, know the sources of finance and credit rationing, understand what is meant by residential investment, understand the relationship between the relative price of housing and the supply of new houses, know the concept of inventory investment and the reasons behind holding inventories, understand the accelerator model, understand how inventories are related to business cycles, and lastly, know just-in-time inventory management concept. Let us first understand business fixed investment. By business fixed investment, we mean that the investment goods are purchased by the firm for producing further goods and that the expenditure incurred on them is for capital and will stay put up for long. In other words, this is the money invested by the firms in further pursuit of its production activities. Examples of business fixed investment include machinery, plant and building, computers, telephones, business vehicles, electronic equipments at workplace, etc. This investment forms the largest component of all types of investments. Business fixed investment as a share of GDP falls sharply before and during recessions and then starts rising as recovery kicks in. Sources of finance and credit rationing. There are different methods which can be employed by the firm to source its investments. These are retained earning, those profits which are not paid out to the shareholders, bank loans, bond market, equity finance. Out of these sources, one source which stands out due to its predominance in financing is retained earnings. There is a close link between the earnings of a firm and its dividend and investment decisions. This is because in case of non-availability of outside funds, the decision to invest would be determined by the assets in hand. Therefore, the state of a firm's balance sheet and not just the cost of capital is important in determining its investment decisions. In this context, credit rationing is also important. This happens when the individuals who are willing to borrow at existing interest rates cannot do so because the lender does not give them the money due to the fear of non-payment, or there are limits to the amount one can borrow. This problem is more so for small firms with little or no credit worthiness. The fact that the retention ratio declines with the firm's size is consistent with this implication. Under these conditions, a firm's investment decision will depend upon the following: interest rate, saving out of past earnings, and current profits. Having said so, the cost of capital is still important in a firm's investment decision because the firms that retain earnings have to consider the alternative of holding financial assets and earning interest rather than investing in plant and equipment. Malleability of capital. Capital is often described as putti, implying that the goods are in a malleable form which can be converted into capital and then back to general goods. Much capital is better described as putti clay, that is, once the capital is built, it cannot be used much except for what its original purpose was. Example, an office building, putti, can be used for many purposes, while an aircraft, putti clay, cannot be used for anything else apart for flying. Thus, an important feature of putti clay investment is its irreversibility. An irreversible investment decision will not be taken if it merely turns profitable, but rather when it is not worthwhile to wait for any further improvement in profitability. Use of discounted cash flow technique in investment decision. A firm has a range of investment decisions to choose from. It estimates the cost and revenues arising from them and analyzes them in the light of the information generated. Depending on the level of interest rate, the firm would choose the projects in which it would invest. The higher the rate of interest would be, the lesser would be the chance of selection of any given investment project. In order to arrive at the total demand for investment in the economy, we add the investment demand for all the firms in the economy at each interest rate. Next, we discuss residential investment. Residential investment includes the purchase of new housing both by the people who plan to live in it and by landlords who plan to rent it to others. Housing can be distinguished from other assets due to its long life. Also, investment in housing in any one year is only a small percentage of the existing stock of houses. The theory of residential investment can be studied in two steps. Step 1. Determination of the relative asset prices of housing by the interaction of the demand and supply curves. In the figure, the x-axis measures the stock of housing and the y-axis measures the relative asset prices of housing. The demand curve D1 is downward sloping because at low prices more units of housing are demanded. At any given point of time, the stock of housing supply is constant and remains unchanged. This is why the supply curve denoted by S1 is shown as perfectly inelastic and vertical. The demand and supply curve intersect at point E1, at which the relative asset price of housing is PH1 by P. Step 2. Relation between the relative price of housing and the supply of new houses. In the given figure, the x-axis measures the supply of new houses, that is the flow of residential investments that the construction companies make in a given span of time, while the y-axis measures the relative asset price of housing. FS curve shows the supply of new houses is positively related to the relative asset price of the houses. This can be explained as the construction companies use inputs to build houses and sell them at the market price PH. Inputs like bricks, cements, etc. are used in the process of construction and their prices depends upon P, the price level in the economy. The higher the relative price of housing, the greater is the incentive to build more houses and greater is the number of houses that are built. The given relative price of housing as determined in the asset market is PH1 by P. At this level, the supply of new houses by the construction companies is OIR1. Assume that the interest rate, that is the rate that potential house owners can earn by investing elsewhere, falls. Then the demand for housing increases from D1 to D2 and the relative price of housing rises from PH1 by P to PH2 by P. This increase in relative price of housing in turn increases the supply of new houses from OIR1 to OIR2. The demand curve shifted because of the change in the interest rate. Other factors that can affect it are wealth of individuals and net returns from house ownership, that is the difference between the gross returns from owning a house like rent, real or implied, and capital gains and the cost incurred on the same like interest on loan, real estate taxes and depreciation. As is visible from the discussion, interest rates affect residential investments. Therefore, the state, by altering its monetary policy via interest rates, both real and nominal, can affect the residential investments made in the economy. This is because most house purchases are financed by loans. The cost of owning a house rises with increase in interest rates. Also, high nominal interest rates dissuade individuals from owning a house because of two kinds of liquidity effects. Firstly, the owner of the building has to make full nominal payment immediately on purchase but receives the capital gain somewhere in the future. And secondly, banks qualify their home loan applicants that don't adjust during periods of high inflation. However, the government of our country encourages house ownership by using its taxation policy, which allows interest payments as well as principal repayment on loan taken for house property as deduction for calculating personal tax. Along with this, the Indian tax laws allow indexation of acquisition cost for computation of long-term capital gains. As a result of this, nominal capital gains due to inflation are not taxed. Moving on to inventory investment. Inventories include stock of raw materials, work in progress and finished goods held by the firms in storage to meet specific objectives. They are an inevitable part of production and distribution processes and represent the capital which is tied up in unsold goods. Reasons why firms hold inventories. Firms hold inventories to smoothen out their production processes. While the demand may fluctuate during the year, the firm continues production evenly throughout the year, building inventories in time of low demand and selling out of inventories in time of high demand. Many suppliers offer quantity discount. Therefore, firms like to buy in bulk and keep inventories of material in order to avail these discounts. Large inventories can help a firm avoid a stock out situation. Sometimes the production process of a good is such that the build-up of inventories is natural to its production. This is true for those goods whose production process takes a huge time to complete. Till the time the good is not produced, it is inventory. When certain goods are brought and sold in batches, holding of inventory becomes inevitable. Inventory sales ratio and factors affecting it. The ratio of manufacturing inventories to sales is called the inventory sales ratio. It depends on the following factors. The inventory sales ratio is high when the cost of ordering new goods is high, the speed with which the goods ordered can be replenished is slow, the sales are low because when sales are low the uncertainty is high, the rate of interest is low. This is because holding of inventories involves tying up of resources and hence an interest cost. The next is the accelerator model. According to Dornbusch et al., inventory investment can be explained by the simple accelerator model. As per this model, investment spending is proportional to the change in output or change in GDP and is not affected by the cost of capital. I is equals to alpha into y minus 1. The net investment is positively related to the changes in expected output. When the expected output increases, the net investment will be positive. When the expected output remains unchanged, net investment will be 0, and if the expected output decreases, net investment would be negative. Anticipated versus unanticipated inventory investment. There can be two types of buildup of inventories, anticipated and unanticipated inventory investment. When the firm builds up its stock of inventory intentionally to meet an expected rise in demand, it is anticipated or desired inventory. While when the firm's expectation about a high future demand turns out to be erroneous, the stock of inventory that gets built up on its own is called unanticipated or undesired inventory. While anticipated inventory investment adds to aggregate demand, unanticipated inventory investment is a result of unexpectedly low aggregate demand. Thus, a high buildup of inventories can be associated with either declining aggregate demand or increasing aggregate demand. The next is inventories in business cycle. Inventories fluctuate more proportionately in business cycles than any other component of the aggregate demand. Recession is associated with falling aggregate demand. This results in unanticipated buildup of inventories. As a result, firms cut back on production and meet the sales through the stock of inventories. When the economy picks up, the firms anticipate a rise in demand and build up their inventories. The next is just-in-time inventory management. If inventories are kept more closely in line with the sales or aggregate demand, fluctuations in inventory investment and in GDP would be reduced. Just-in-time inventory management is a concept which has been borrowed from Japan. It emphasizes the synchronization of suppliers and users of materials in order to allow the firms to operate with smaller inventories. It brings together all inputs needed at each stage of production at the precise time when they are needed. As a result, the investments in inventory have reduced. Let us now summarize what we have learned in this module. Investment is the flow of spending that adds to the physical stock of capital. Investment can be divided into three subsectors: business fixed investment, residential investment, and inventory investment. Business fixed investment is the money invested by the firm in further pursuit of its production activities. Credit rationing happens when the individuals who are willing to borrow at existing interest rates cannot do so because the lender does not give them the money due to the fear of non-payment, or there are limits to the amount one can borrow. An irreversible investment decision will not be taken if it merely turns profitable, but rather when it is not worthwhile to wait for any further improvement in profitability. The higher the rate of interest would be, the lesser would be the chance of selection of any given investment project. Residential investment includes the purchase of new housing both by people who plan to live in it and by landlords who plan to rent it to others. The supply of new houses is positively related to the relative asset price of houses. Factors that affect the demand of housing are interest rate, wealth of individuals, and net returns from the ownership of house. Both real and nominal interest rates affect the residential investments. Inventories include stock of raw materials, work in progress, and finished goods held by the firms in storage to meet specific objectives. The ratio of manufacturing inventories to sales is called the inventory sales ratio. As per the simple accelerator model, investment spending is proportional to the change in the output or change in the GDP and is not affected by the cost of capital, and this relationship can be described as I is equals to alpha into y minus 1. Anticipated inventory investment adds to aggregate demand, and unanticipated inventory investment is a result of unexpectedly low aggregate demand. Inventories fluctuate more proportionately in business cycle than any other component of aggregate demand. Just-in-time inventory management concept deals with bringing together all inputs needed at each stage of production at the precise time when they are needed. Anticipated inventory investment adds to aggregate demand, and unanticipated investment is a result of unexpectedly low aggregate demand. Just-in-time inventory management concept deals with bringing together all inputs needed at each stage of production at the precise time when they are needed.